Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at PayPal.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and real quick before we get completely into the weeds, I do want to mention VIP Algos.
Oh, right. Yeah, the link is below in the description.
Exactly. It's a really useful TradingView indicator suite. So if you're trying to, read these chaotic trading charts more clearly, it gives you these great visual buy and sell chart alerts.
Which is super helpful.
Totally. It helps you plot trend direction, flags your support and resistance zones, and it even helps out with take profit and stop loss planning areas.
Yeah, but we always have to remind you, right? It is strictly an educational tool only. It is definitely not financial advice.
No, absolutely not.
Yeah.
It doesn't place trades for you, and it obviously does not guarantee profits.
Yeah.
Trading always involves risk.
So you really have to manage your risk and do your own research. And again, that link below is an affiliate link, meaning we may earn a commission if you use it at no extra cost to you.
Right.
All right, let's move into the wealth building context, because if you've been holding PayPal in your portfolio over the last half decade, well, looking at its stock chart probably makes you sick to your stomach.
Oh, I'm sure it does.
I mean, we are talking about a staggering 85% drop from its all-time highs.
Yeah.
It's trading at multi-year lows right now.
Yeah, it's been absolutely brutal. But it's entirely about separating that backward-looking price trauma from the forward-looking business reality.
Right.
Because if you're approaching this from a portfolio strategy perspective, you really have to recalibrate your expectations.
Yeah.
This is not, and I repeat, not the hyper-growth pandemic era darling it was back in 2020 or 2021.
Yeah, it has completely shed that identity. Like, that version of the company is just gone.
Exactly. What you're looking at now is a classic value and turnaround profile.
Yeah.
And that distinction, it's absolutely crucial.
House.
Well, I mean, if you're a momentum trader looking for some speculative overnight rocket ship, this is probably not your arena. But if you're a patient long-term investor looking for a valuation reset, this landscape is genuinely compelling.
See, I have to play the skeptic here, though. We've all heard the phrase catching a falling knife, right?
Sure. Yeah.
When a stock is down 85%, trying to pick the bottom usually just leaves you bleeding. Historically, companies that fall this far usually have something like fundamentally broken inside them. So what makes this a genuine turnaround story rather than just a dying business getting progressively cheaper?
It really comes down to one indisputable metric, and that is underlying cash flow mechanics.
Okay.
Unpack that. Well, when a company is truly a falling knife, it's usually because the business model is just hemorrhaging cash, or they're drowning in high-interest debt, or facing this existential crisis where they literally might not be able to keep the lights on next year.
Right, the doom spiral.
Exactly. And that is definitively not what is happening here. They are printing billions of dollars in free cash flow. The core engine isn't broken. It's just operating at a different, slower speed than the market got used to during the stimulus days.
That gives us the bigger picture. Now let's look at the fundamentals. Because if Wall Street is pricing this like a turnaround, we really need to look under the hood.
Definitely.
Let's talk about the top line. Because trailing 12-month revenue growth is sitting at 5.79% year over year, which is a very polite way of saying it's in the single digits.
It is, and that's exactly why that massive growth premium vanished. But you really have to look past the top line and examine the margins here.
Which are holding up.
Better than holding up.
Yeah.
The gross margin is incredibly strong at 40.93%, and they are pulling a net margin of 15%.
Wow. Just to put that in perspective for you, keeping 15 cents of pure profit on every single dollar that flows through a massive global payments platform that is highly efficient.
It is highly efficient. And the mechanism behind that efficiency is fascinating. They're getting there partly through some incredibly aggressive AI-driven cost optimizations.
Okay, wait, how exactly does that work? Because when companies say AI optimization, it usually just sounds like a corporate buzzword for, firing people.
Right, but it's much deeper than that here. Think about fraud detection, which is easily the biggest expense for any financial network.
Sure.
They've replaced these massive, slow, legacy human fraud detection teams with advanced AI models. These models can process thousands of complex transactions a second with vastly lower error rates.
Oh, wow.
Yeah, and they're also automating merchant onboarding and customer service. So they're systematically slashing their overhead while processing the exact same volume of money.
Okay, 15% net margin is solid. But where is all that cash actually going? Because if they aren't growing at 30% anymore, they better be doing something smart with the money.
It's piling up, honestly, and they are using it aggressively. The balance sheet is a fortress right now.
Yeah.
They're generating over $5.2 billion in free cash flow for fiscal year 2025.
5.2 billion, that's massive.
It is. And here's the kicker. They are taking that cash and buying back over $6 billion in common stock.
Wait, I need to pause you on the valuation piece because this is where my alarm bells are ringing.
Okay, lay it on me.
I mean, we're looking at a PE ratio, a price to earnings ratio of 8.08, price to sales at 1.21, a price to book around 2.04.
Yeah, those are multi-year lows.
Massively below their fintech peers. Usually when the broader market assigns an 8x PE to a tech stock, that is Wall Street screaming, your best days are permanently behind you. I mean, a price to book of 2 essentially implies zero expected growth forever.
That is exactly the assumption priced in right now, terminal stagnation. But this is where those aggressive share buybacks change the mathematical reality entirely.
How?
Well, when you have a PE of 8, your stock is dirt cheap. So if the company takes $6 billion of its own cash and buys those cheap shares off the open market, they are retiring them.
Right.
They're drastically reducing the float, the total number of shares available to trade. So even if their actual net income stays perfectly flat, the earnings per share, the EPS, can grow substantially because that same profit is being divided among far fewer shares.
It's like they're boiling down a pot of soup.
Exactly.
The total amount of the net income is exactly the same, but by aggressively boiling away the extra water, meaning the outstanding shares on the open market, every single spoonful you take is vastly more concentrated. Your share of the profits gets bigger even if the total profit doesn't grow 1 cent.
That is a perfect analogy.
Yeah.
And they have the structural moat to keep the heat on that soup.
Yeah, a massive moat.
We're talking about a two-sided network of over 400 million consumers and over 35 million merchants globally.
Mm-hmm.
Plus you have Venmo, which just has incredible social stickiness in the U.S.
Which is incredibly hard to replicate. You can't just write some code tomorrow and suddenly have 500 million people and millions of global merchants trusting you with their bank accounts.
No, you really can't.
Not to mention dealing with local regulatory compliance in 100 different countries.
Exactly. The moat is deep.
That gives us the business picture. Now let's move to the catalyst timeline. Because cheap stocks can stay cheap forever, right?
Very true.
So what is the actual spark, the catalyst, that is going to force Wall Street to wake up and reprice that 8x PE in the near future?
The first major test is the Q3 2026 earnings, which are coming up in late July or early August. Everyone on Wall Street is going to be hyper-focused on branded checkout volume.
Right, that's the classic recognizable button you click when you buy something online.
Exactly. They need to show that growth there is re-accelerating, and they need to show concrete metrics on how they are monetizing Venmo beyond just, peer-to-peer transfers.
But wait, if the market expectation is basically zero growth, as we saw with that depressed valuation, is a beat at Q3 already priced in? Or is the bar sitting so incredibly low right now that even a modest EPS beat could trigger a really violent upward re-rating?
Oh, it's much closer to the latter. It is an asymmetric setup.
Okay, tell me more.
Well, when a stock is priced for perfection, say, trading at a 50x PE, any tiny mistake causes a crash. But when you are priced for doom, as they arguably are at an 8 PE, a merely okay quarter can send the stock surging simply because the worst-case scenario didn't materialize.
That makes total sense. Okay, what else could force a repricing?
We have to talk about PYUSD. They are officially expanding their regulated stablecoin to Polygon's rails. This is a huge catalyst.
Let's unpack the mechanics there.
Yeah.
Putting a digital dollar on an international blockchain network. Why does that actually matter for their bottom line?
Because of the massive inefficiencies in cross-border payments, payroll, and B2B disbursements.
Yeah, it's a nightmare.
Moving money internationally right now through traditional banking rails like SWIFT requires multiple intermediary banks. Each one takes a cut, and the whole process can take 3 to 5 business days.
It's slow and it's expensive.
Exactly. By bridging traditional finance and decentralized finance DeFi with a regulated stablecoin on a remarkably fast network like Polygon, they can settle complex cross-border transactions in seconds for fractions of a penny.
Wow.
They're positioning themselves as the regulated bridge ahead of an institutional wave. It's a whole new, highly scalable potential revenue stream.
I want to bring up the macroeconomic picture too, because Kevin Warsh has just been confirmed as the new Fed chair, and everyone basically assumes a rate cut cycle is a magic bullet for fintech companies.
Right, that's the con, wasn't it?
But let me push back a little. What if inflation is sticky and those rate cuts just don't happen? Does this 8x PE thesis completely fall apart without Fed help?
It doesn't fall apart,
Hmm.
but it does remove a major tailwind.
How so?
Here is how the mechanics work. Lower interest rates reduce the discount rate that Wall Street applies to future earnings. So when the discount rate drops, fintech multiples naturally expand.
Right.
If rates stay flat, PayPal just has to rely entirely on its own buybacks and earnings growth. So rate cuts are a bonus catalyst, not a structural necessity at this valuation.
What about the regulatory side? I know there's been a lot of noise in Washington about cracking down with new buy now, pay later regulations. Usually government regulation is a massive headwind for growth.
It is a massive headwind for startups. But new buy now, pay later regulations could actually be a huge catalyst for an incumbent giant.
Wait, really? Why? Because they can afford the lawyers?
Essentially, yes. Compliance is incredibly expensive.
Yeah.
If the government creates a strict, complex regulatory framework, it immediately crushes the small, less regulated fintech upstarts who just can't afford the legal overhead.
I see.
The market then naturally consolidates around the giants, who already have the legal teams, the banking licenses, and the compliance infrastructure in place. Regulation literally becomes a moat. Catalysts tell us what could change the story. Now let's pivot to the chart.
Yeah, because we have the fundamental thesis and the catalyst that could spark a rally. But is the price action actually confirming any of this? Because if the smart money isn't buying, the thesis is just theory. What does the chart look like?
Let's look at the structure. It last traded at $46.32. That means it is still 41.7% below its 52-week high of $79.50.
Right.
But importantly, it is 20.6% above its 52-week low of $38.46.
So it's bouncing off the absolute bottom.
Yes, it's showing tentative stabilization. It's locked in a base building pattern right now. The key resistance zone is right above in the $48 to $50 range.
And if it breaks that?
If the price can break out above that specific level, it officially confirms a higher low structure. That's a classic technical signal that a multi-year downtrend might finally be exhausted, and the volume is completely normal, holding around 15.3 million shares a day.
Normal volume is key there. It means there's no panic selling happening anymore. The capitulation is over.
Exactly. It looks like quiet, systematic accumulation. But the absolute most crucial technical signal here, the one that really demands attention, is the insider buying.
Oh, this is fascinating.
Over a 90-day period, company insiders purchased a net of 884,236 shares.
Now wait, I dug into those SEC filings and saw there were 28 buy transactions versus 34 sell transactions. That's technically more selling transactions than buying.
Yes, the transaction count favors selling, but the actual dollar value of the buys heavily outweighs the sells. That is why the managerial sentiment price ratio, or MSPR, is currently sitting at 64.48, which is a very strong positive signal.
Hold on, let's unpack that metric for a second. What exactly is the MSPR and why does 64.48 matter?
So the MSPR is a metric that basically measures the conviction of insider buying on a scale of 1 to 100. A score around 50 is neutral.
Okay.
A score of 64 means the executives and directors aren't just casually buying a few shares to look good. They're aggressively loading up. It's cluster buying at depressed levels.
I always think of insider buying like being on a cruise ship, you know?
Right, yeah.
Like if you see the passengers running for the lifeboats, that's one thing. But if you look up and see the captain, the chief engineer, and all the officers quietly walking over to the ticket booth and buying up all the available cabins for the next voyage, you realize the ship isn't sinking.
That's a great analogy.
The crew knows something about the structural integrity, the mechanics of the hull that the panicking passengers just don't. And cluster buying at multi-year lows is one of the most historically reliable bottoming signals out there.
It really is. The people with the deepest insight into the product pipeline and the profit margins are putting their own personal wealth on the line.
So the chart gives us price structure. But what does market sentiment look like? Because the chart shows quiet accumulation. But how is the broader narrative reacting to this base building?
The overall sentiment is shifting to moderately bullish. We're seeing a distinct move away from those pure value trap fears and moving toward a more constructive optimism.
Which is nice for a change.
Yeah. The market is finally starting to digest those AI cost savings and the stablecoin innovations we talked about. But there is a mechanical dynamic at play here too, which is the recent index reshuffle.
Right. This happened pretty recently.
Yes. They were removed from the Russell Top 200 and the Russell Top 200 value indices, and they were simultaneously added to the Russell Midcap and Russell Midcap value indices.
Wait, getting kicked out of a megacap index sounds like a massive demotion. How does that impact the stock mechanically?
Mechanically, in the very short term, it creates artificial downward pressure.
Because of the passive funds.
Exactly. When you leave a top 200 index, all those massive passive funds that track that specific index are forced to systematically dump your stock, regardless of whether they like the fundamentals of the company or not. It's just indiscriminate selling.
But the flip side is...
The flip side is, you are now a very big fish in the mid-cap value pond. It opens the door to a whole new base of institutional buyers. Mid-cap value-focused mutual funds and ETFs now have a mandate to initiate or add to their positions.
And what about the M&A rumors? There's been a lot of unconfirmed chatter out there about a potential buyout.
It is entirely unconfirmed, so we have to treat it really carefully.
Yeah.
But mathematically, at a sub-9x PE and a market cap that is compressed down to around $41 billion, it creates a very logical take-private floor.
Explain the math on that for us.
Private equity or strategic acquirers use leverage based on cash flow. So when they look at $5 billion in guaranteed free cash flow against a $41 billion price tag, the math for a leveraged buyout starts looking incredibly attractive. They could theoretically buy the company, use its own cash flow to service the debt of buying it, and walk away with a highly profitable payments network. That reality puts a psychological floor under the sentiment. Wall Street knows it's getting too cheap to ignore. That sentiment picture is useful, but we still need to talk about the risks.
Oh, absolutely. No stock drops 85% without some real monsters in the closet. What is the biggest threat right now?
The monsters are real, and the biggest one is execution risk and the sheer heat of super app competition.
Let's talk about Elon Musk's X Money app, because this is the part that keeps me up at night if I'm holding this stock.
It's a big deal.
X Money is targeting consumer finance with a massive 6% APY, 3% cashback, and free ATM withdrawals. I mean, that is practically a bank killer proposition.
It really is an aggressive move.
Plus, you have legacy players like Synchrony Financial completely reorganizing their internal structures to accelerate their own AI growth. Market dominance is never permanent, you know. Do you really think 400 million users are loyal enough to a legacy checkout button to ignore a 6% yield from a direct competitor?
Look, it is a genuine threat to consumer-side engagement, absolutely. But we have to look at the mechanics of a 6% APY. In the current rate environment, that is not a sustainable business model.
It's just a loss leader.
Exactly. It is a massive cash burn strategy designed solely to acquire users. It's incredibly expensive to maintain. PayPal's merchant network and regulated infrastructure took over a decade to build globally. X Money is still in the very early stages of trying to build trust. PayPal has a multi-year head start on the actual unglamorous payment rails and regulatory compliance.
True, but if X Money bleeds them even a little bit and customers shift their balances over for the yield, growth goes from single digits to negative.
Which is exactly why the valuation is the ultimate mitigation here. If the stock were trading at a 30x PE, X Money would be terrifying because perfection would be priced in.
Right.
But in an 8x PE, a significant amount of that competitive erosion is already priced into the stock. The market already assumes they're going to lose some market share.
What about the lingering effects of that index deletion we just talked about? Is that selling over?
There is always a risk that the passive selling pressure from the Russell Top 200 hasn't fully cleared yet. But considering the stock actually bounced nicely off its absolute bottom recently on normal volume, it heavily suggests the market has largely absorbed that forced selling.
So with everything on the table, what's the final verdict?
Based on the research, the bullish score is a solid 7 out of 10. The target horizon here is a swing to intermediate trade into the Q3 2026 earnings, so we were looking at a 3 to 6 month window.
Okay.
However, there is strong justification for a multi-year hold if you are a patient value investor looking for a structural turnaround.
So it's an asymmetric setup.
Exactly. The downside feels heavily protected by that sub-9x PE and the $5 billion in cash flow funding aggressive buybacks. The floor is solid. Meanwhile, the upside is just waiting to be unlocked by any sign of checkout reacceleration or stablecoin traction.
And as always, a mandatory safety check. Clearly, this is not financial advice. You're listening to a discussion of research, and you must do your own research and make your own decisions.
Absolutely.
And hey, if you want a cleaner way to read trading charts, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
It's super useful.
It is. It can really help make charts easier to scan, but it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
It really all comes back to how we view the evolution of finance. We want things to be binary, either a hyper-growth stock or dead money. But the reality of a multi-year turnaround is deeply murky. It makes you wonder, when the dust finally settles on the digital payments war, will the future of money actually be won by legacy tech throwing around flashy cash burn yields? Or will PayPal's quiet integration of stablecoins make them the first true bridge to Web3? Keep a close eye on that Polygon integration. It might just be the most important thing they do this decade. Something for you to think about.